Great.
Yes.
So I'm going to cover basically a few slides today, and it's mostly going to be centered around inflation because that's the hot topic right now, and what the Fed might do in reaction, because that's the most important piece about it. So this is going to take a little bit of a while to explain because it's a little bit of an involved slide. So bear with me, and if you have any questions, please jump in because it might not be that easy. So there's 4 important lines on this, and those are going to be the equity market future returns, realized and predicted, and the 10-year yield future returns realized and predicted, and then there's essentially the logarithmic price of the S&P 500, which is that blue line that you guys can see. Can you guys see my mouse, by the way, or not?
Yes.
Okay, great. So now I'm going to go down into the sort of the detail. If you look at the dark blue line here, that's the realized future 10-year returns from that date of the S&P 500 on a total return basis and on a nominal basis. And then in the orange line is essentially what the regression would give you. And the regression is about a 77% correlation, so it's a good regression. So it basically gives you what the prediction for the next 10 years are starting at any point in time. Right now, it says that we're roughly predicting, if you look at where that orange line is now, it's right on that 5% line over there. So it's predicting that over the next 10 years, we have about a 5% nominal return. The gray line is the same thing. The gray and the yellow line are the same thing for the 10-year treasury. So it's looking at the total return on the 10-year treasury, total return of the bond of the 10-year treasury, constant maturity. So if you were to basically systematically reinvest into a 10-year bond every month. And what you can see is that, so the gray line is what the actual return on the 10-year bond over the next 10 years were. And then the yellow line is what the predicted value of the next 10-year returns, future returns, would be based on the regression. So right now, if you look at that on the yellow side here, and the reason that this gray line is at 0 is, of course, because since it's 10 years forward, you don't have any data for that now. You still have to be that realized. So what it's predicting currently, the prediction would be about 70 basis points. So if there's anything to take away, is that bonds are very expensive and that investing in bonds won't likely have a big return over the next 10 years. 70 basis points is basically what the future 10-year return is predicting. But the equities aren't doing that great either. The next 10-year returns at 5%, which is not huge, but is better still. And so I took a few data points out, and that's why you see these black boxes here. They're pointing out 2 points in time where the S&P 500 had a higher valuation based on a cyclically adjusted PE ratio, because the model that's being used here for equities is the cyclically adjusted PE ratio, and for the bond is basically just the yield. The yield is the best predictor of future returns on bonds. And so if I were to take the 2 points in time where you had a high valuation on equities, or the highest that we've seen is again in that in 1964. And if I do the proportional ratio of what our current cyclically adjusted P ratio is versus what it would be if we were to hit this multiple, we would be going from what was at the end of the first quarter was 4,208 on the S&P 500 to 4,800. So if we were to basically have this yellow line, or go down to the same level here that you had in 1964, that would roughly mean that the S&P 500 would go to 4,800, assuming no growth in earnings. But given this is an average earning over the past 15 years, the growth in earnings won't have a huge impact on that increase in valuation. Similarly, if we were to compare it to the dot-com bubble, which was the most overvalued piece since the Second World War, if we were to get that same multiple, it would be about 5,400 would be the target on the S&P 500. So that gives you 2 sort of anchor points where the equity markets could go based on what historical maximums were. Now, bearing in mind, they don't need to stop there. The Japanese stock market in the 1990s, I think, went over 100% cyclically adjusted P. 100 cyclically adjusted P ratio. It's not percent; it's just 100. So it can go higher, it can go further. But these are, at least for the U.S. equity markets, fairly good anchors to think about. And I'll pause there and I'll see if there's any questions and if the graph makes sense. Anybody, please chime in.
Looks fine.
All good? Barry?
So basically, you might as well just go for the risk in the S&P than
Yep.
going for the safety of the treasury notes or bills.
So the point is you probably want to be more weight on equities than you would want to be on bonds, bearing in mind that it can't hurt to add a little bit of bonds to your portfolio because they're not 100% correlated and they're unlikely to be 100% correlated. So you can benefit from the diversification. In order to really benefit from that diversification, you'd need to use leverage to be able to adjust basically your bond to the same amount of risk that you'd be taking on your equities. So it is probably more appropriate for people who aren't using leverage on their bonds that you probably want to have a much bigger overweight to your equities these days than to your bonds. It also doesn't say that this says nothing about when the market's going to crash. So the sort of flip side to this is as this yellow line gets more and more towards the zero or the lower multiples, the lower returns, the higher multiples, the lower returns, the more and more it's risky, right? The higher your valuation relative to your earnings, the more likely you are to experience lower returns going forward. Does that make sense?
Yes.
There's the earnings growth. You don't use any projections for the earnings growth since that you're using historical averages over the past 15 years. And the reason for that's what Robert Shiller used 10 years, but 15 works as well. 15 gives a little bit better R squared on the regression, so that's the reason for it. Is that it sort of smooths out if you have a recession and boom. So it basically gives you an average between sort of a whole cycle. So you don't need to make any projections on the future earnings in this case. It's not projecting future earnings. If there's no other questions on that or no other additional comments, I'll move on. There we go. So one of the things that to bear in mind, and this is from Schwab, is that we've had one of the strongest earnings rebound ever after a recession. So what you can see here is what the earnings rebound is 12 months after a recession. So 1 year after the recession low, how high have the earnings rebounded on a percentage basis? And what you can see is this 2020 earnings rebound is unprecedented, which is a word that's been used unprecedentedly over the past year or so. And since the post-World War II era, you haven't had any rebounds of this magnitude. First of all, it's very unlikely that you have a positive rebound 1 year after a recession, and even more so to have this much of a positive 20% rebound. So bear in mind this is very exceptional and is due to the sort of the fiscal policy and the monetary policy combined. So don't get used to it.
I was going to say without government funding, you wouldn't see that type of recovery.
Exactly.
Which puts it in a little bit of doubt if they start pulling money out.
Well, that's why I think really what fiscal and monetary stimulus do is very key to how assets are going to appreciate. So here,
one question. I'm not sure I understand meaning of negative rebound. How a rebound could be negative if you are...
1 year after a recession often lasts more than a year. So if you in 1953, you still had your earnings were still dropping in 1954. Is all it was saying, that your earnings decreased even after 1 year after the recession. That's all it's saying. It says in 2020, it's the opposite. It's actually it's increasing 1 year after the start of that recession. Does that answer your question, Roman?
Say it again. I'm sorry. I didn't get it.
So generally speaking, a recession doesn't last 1 year. And what this is looking at is 1 year after the start of the recession, what's the year-on-year change of earnings? So generally, 1 year after the start of a recession, you're still in a recession because a recession tends to last somewhere around 2 years.
Okay.
And so in this case, the recession was so short that the earnings started rebounding positively, which is not very common. And it's the highest it's ever rebounded because it's 20% up relative to what it was at the start of the recession.
You're talking about 2020, right?
I'm talking about 2020. 2020 is the biggest and most strongest rebound we've had in earnings after a recession.
But 1990, let's say.
1990 is there. It was minus 20%.
So why you call it rebound if it was minus 30% compared to what it was prior to recession?
It's
Why?
it's the change after 1 year on the earnings. So your earnings has a certain level. You go 1 year from there, you look at what the change was year on year. That's the percentage that you're seeing on this graph. And then you look at it, if it's negative, generally speaking, that's what usually happens after a recession, as earnings still go down. But in the case of 2020, earnings went up 1 year after.
Okay.
Yes, we are recording this. Moving on to CPI. So this is actually core CPI that I'm showing you. And the reason I'm talking about is today we had a CPI print. I don't know if you followed it, but it was a chunky core CPI. It was 3.8%, which is a pretty big jump, as you can see. So that's the purple line, which is the realized core CPI. So it's the year-on-year CPI. So that purple line you see, since 1995, we haven't had a print of 3.8%. And then this is I've showed this to you before. So the red line is basically the equity market, the S&P 500 total return. And then that black line is basically a model I use as a CPI forecast. Historically, it's not been too bad at predicting changes or forecasting CPI because it's a forward-looking measure. But with the recession and the amount of fiscal and stimulus and reaction and policy reaction to it, it's got quite off. But essentially, what it's also telling us is that we're probably going to be, even though that you get this big jump, we'll probably head back towards something lower, sort of that 2% range. There's a big base effect that's probably happening right now, where CPI is jumping because it got so low during the post-pandemic last year, post the start of the pandemic, that it just jumped much higher based upon that. And we'll see this normalize because these are year-on-year measures. So if you have a very low print in May of last year, it's easy to then have a big increase on a percentage basis. So drilling down more into CPI, what has sort of caused that? So if you look at it, and this is, I think this was quite interesting, this from Guggenheim. It says temporary factors boosted April CPI. And so if you looked at these are different factors that go into core CPI. So the one that we're really looking at these days is used cars, because that has one of the biggest effects. So if you look at that bar on the right, it's building up what contributed to CPI. So the biggest effect was used cars. Second biggest effect was hotels. The third was car rentals, and then the last was airfare. And so that's not too surprising. People started buying cars during the recession. So car prices have been going up, and there have been supply chain issues. So used car prices have been appreciating quite a bit. Hotels basically got decimated because of the pandemic. Same with airfare. No one was traveling. So these start from a very, very low base and now are basically just increasing. And with the increase in oil on top of that, you get airfare that's going up. So that this is a lot due to some of the base effects that happened post the pandemic, because these things cratered. As you can see around here, they cratered quite a bit. Mm-hmm. And then there's also a shift in consumer habit, because people were going to use transportation, mass transportation, and a lot of people, instead of using mass transportation, one, didn't commute into work, and second, felt more comfortable using a car because of the pandemic than they would have felt using sort of transportation services, which is generally mass transportation. Does that make sense?
I might add that right now the majority of jobs, the biggest boom in hiring is among the hotels and the airlines, and the hospitality industry basically is now experiencing the biggest boom in employment right now.
Yes, I'm gonna get to that, and I don't know if did I put it in there. Yes, so I'll get to the jobs at some point, but it's in there. So the second piece of CPI, core CPI, is rent. OER is owner's equivalent rent, and healthcare. So that has stayed a little bit more stable, all those factors. So even if you have a home price appreciation, because interest rates stayed low, basically your owner's equivalent rent really is the house price times the interest rate, really. Mm-hmm. That's the owner's equivalent rent. So even if house prices go up, but your interest rates have gone down, essentially your owner's equivalent rent is roughly the same. And that's why that contribution to core CPI isn't substantial. And same thing for about rent, and same thing for healthcare. These things have been fairly stable and haven't really contributed to CPI too much. And by the way, this factors in April. It doesn't have the last print in May, because I didn't have the graphs weren't available yet. So these two things don't even account the May numbers. So this is what I was trying to portray. On this graph, you have the CPI in the sense this is not the year-on-year change, but the actual CPI number of used cars in blue and of transportation services in red, because those are the two biggest increases of the May inflation piece. And what you can see is during the pandemic, that transportation services CPI dropped quite a bit, which makes sense because no one was using mass transportation. And then used cars was already at a low basis, but there was a big adoption where people went away from transportation, mass transportation, went to drive their own cars, and that's really driven basically used car prices up. So this one is unlikely to be sustained on a long-term basis. Once someone has a car, they're not going to be buying I mean, you don't really need more than 2-3 cars, maybe 3 cars per household. Especially if you're buying used cars, you're probably not buying sort of your Ferrari or Porsche, which you use just on the weekend. So it's unlikely that this thing will be highly sustained over the long term. So you would imagine this thing would subside at some point. And there's also supply chain disruptions due to COVID, right? Because people weren't necessarily transporting goods through ports. So you also had problems of imports and exports that contributed to it.
Actually, public transportation during the pandemic became free of charge. You used to have to pay for it before the pandemic. During the pandemic, because bus drivers didn't want to be infected, it was free of charge. You entered the buses through the back door. You took a seat. You didn't get anywhere near the bus drivers, and it was free.
That was
so
nice.
The price was definitely right. You couldn't beat the price.
And so all this has been reflected in how the Fed has been talking. So if you look at this is an analysis by Arbor, and it looks at basically in blue, essentially the usage of the language transitory as it relates to inflation, and it measures it on a historical basis, and then looks at its standard deviation. So assuming the higher the blue line, the more they use transitory in their language, the lower the blue line, the less they use it. And then you can use the same thing basically if you're just search the web. That's the orange line on a global basis. So what you see is that since 2020, there's been a huge increase of the use of the word transitory in the inflation terms. And so the Fed is also aware of this, and that's why it suggests that they won't react to this big increase in inflation because they believe it's transitory, whether it's right or it's wrong. I believe that's probably true, but regardless, they're unlikely to react at this point to this increase in inflation. So they're unlikely to start tapering right away or to increase interest rates. If you look on a global basis, inflation expectations are starting to trend higher, and the United States is the leader in inflation expectations, which is sort of a good and bad thing at the same time. The Fed wants to get inflation, has been having a hard time over the past 10 to 20 years of getting the inflation up. On the flip side, inflation, if it gets out of hand, is problematic, but where we are right now doesn't make it is not too worrisome. And so you can see people like Japan has been in an inflation doldrum for basically since the 1990s, and that's problematic. So you'd much rather be the United States than Japan, generally speaking. But the United States is up there in terms of inflation expectations. That's not super positive for bonds, which is also why that 70 basis points future 10-year returns is where it is, because there's a chance that interest rates increase over the next 10 years, and that wipes away a lot of your bond returns. Another sort of unprecedented move is the increase in commodities, which is driving part of that inflation that we're talking about. Bearing in mind, commodities generally don't come into account, at least not directly into core CPI measures, because core CPI is CPI less food and energy. Commodities, food and energy tend to be commodities, so they don't go directly into the core CPI count. So the Fed is less concerned about the increase in commodities, generally speaking. So they're less worried about this. But what this graph shows is that after a recession, what is and these are the different recessions here on the right, the start date or different, I'd say market corrections is probably more accurate. how long the bounce, what the bounce looked like X number of trading days later. And so you can see relative to the, essentially since the 1970s, which is even before that, sorry, 1960s, 2020 has been the strongest rebound in commodities from any correction. And the only time that you had almost a more parabolic advance at some point is 1971, and that's when you started getting runaway inflation. 1971, if people remember, that was an inflationary bust. Inflation went up, then there was a recession where they had to debase from the gold standard. It's one of the inflationary busts are very ugly. And so this sentiment of inflation is already permeated into the market, and a lot of people. So this shows the main thing that people are investing in, and where are the most inflows of cash into different asset classes. And so you've seen over the course of time, there's been a lot of different asset classes. More recently, gold, tips, and financials have been a big inflow of cash, of people where people are investing, and that's largely driven by people's fear of inflation. So we may be at a point where the narrative on inflation's got a little bit ahead, probably where inflation might pan out over the next 6 months to a year. So that's just to be wary about that. Again, another sort of graph demonstrating this is the expectations or positioning of people relative to history, given different asset classes. Bonds are clearly out of favor, and that's probably for good reasons. Commodities are one of the strongest positionings. The pound is also a strong positioning because bear in mind there was Brexit in 2016, and the pound got decimated. Now that Brexit is resolved, and if you want to diversify your currency, it's not a bad place to be betting because we're still below 2016 dollar to USD ratio. So we were roughly about 150 before Brexit. Now we're roughly, I think, at 141 on the pound dollar exchange. So it's also a way essentially to hedge currency debasement or inflation. That banks is similar to what I was saying, financials. People look at financials because there's a steepening of the yield curve because they think interest rates on the long end of the curve will go up, but the short end will stay flat. That tends to drive margins for banks because they borrow on the short term, lend on the long term. And then materials is also driven by essentially commodities because that's essentially metals and mining, that sort of thing. And again, UK is essentially, again, that a play on the same thing that I was talking about, that Brexit rebound. Any questions so far? Any thoughts, comments? Okay, moving on. Okay, and this I thought was an interesting graph. So by MacroOps via B of A research via MacroOps, this shows core PCE and then the employment cost index. So one of the things that you can see here is that they tend to be highly correlated, and a lot of people tend to think that for inflation to really take off, you need wages to go up and you need wage inflation. And what this is showing is that actually the employment cost index hasn't been moving that dramatically right now. And what they're saying is that you probably need a 10% increase in wages in order to return to higher inflation. So this sort of puts a dampener that inflation is going to hit the ground running right away. So what is the Fed stance? The Fed stance is that inflation is transitory. Inflation above 2% is good, and it's a good problem to have. I didn't write that right. We probably will get there at some point. It's just not happening right away. I mean, we'll come back down. It's not going to be a sustained because the way that the Fed has portrayed it is that they wanted to average above 2% for a long time. So the averaging piece hasn't gotten there yet. What we should be starting to look for is in the next Fed meeting. So talk about the July and and beyond meetings is to check for any discussion of tapering, because that'll probably be the next step. The Fed is not going to start hiking until they start tapering. So it's what the market will be looking at is if there's any discussion of tapering or when tapering might start. And the other thing is because the Fed has a dual mandate, like we said, it needs price stability. So that's the inflation component, but it also needs full employment. And so there's a huge dependency on the employment, and the Fed is really focused on that these days. They're not too worried about inflation going up, but they're really worried about getting employment back down to levels, pre-pandemic levels. So inflation is going up, right? So at least over the short term, but employment is not recovering as strongly. So that puts the Fed in a slightly uncomfortable position, and they're going to probably privilege employment at this point, given what they've communicated. So this goes into so because of that, we're going to talk a little bit about employment. So this looks at basically the categories of job losses in the different, so the job losses in the different sectors. So of course, some of the worst job losses were in leisure and hospitality, and we still haven't really recovered there, as you can see. So we're the worst, the bottom part of it was I think we were slightly around 20-25% in leisure hospitality. We recovered a little bit since that, but we're still not back to February 2020, which is the month pre-pandemic. And so you can see that there's still a decent amount to go. There's 2.5 million jobs just in leisure to get back to. The other important factor is that the rebound in employment has not been equal in the different income levels. So here you can see three graphs. The bottom one is the low income level. The middle one is the middle income level. And the high one is the high income. People in the high income zone, in the high income level, did not suffer very much from job losses. It dipped quite a little bit, but then it recovered pretty quickly. Middle income was a little bit worse, but still not bad. Low income workers have not recovered. And that has to do often because they tend to be driven by that leisure and hospitality because they're in-person type of work, whereas the high income and middle income tend to be more office-based, so it can be done remote, whereas low income is not. So the reopening of the economy really needs to help that low income, which is also why the fiscal policy targeted mostly low income earners, so the stimulus checks. And going into that employment again, low wage industries see the fastest wage growth. And the reason because of it, and I'll get to that a little bit later, is because of that fiscal stimulus. Now small businesses have to compete with a fiscal stimulus check in order to hire workers. So in order to get so on the x-axis, this is the average hourly earnings, and that's the annual growth in average hourly earnings from March to May. So essentially the start of the reopening. And what you can see is that because you're competing with stimulus checks, that $15 an hour minimum wage, well, leisure and hospitality workers, they're going to have to get to pay them a lot more than they used to because, well, if I can make the same thing staying at home, I'm going to stay at home. So now they're basically, the businesses are sometimes competing with the government in terms of payment. So you can see it.
I think
Go ahead,
part of the problem there too is that those low income workers they're first to feel the effects of inflation, but also they have childcare issues that if they're not making a decent amount of money, childcare is very expensive, and so
it doesn't cover the cost of childcare. Their wages going back to work doesn't cover the cost of childcare as well. Yes. So
correct.
if you're a dual, if two people are working, now one is maybe staying at home so they can take care of the kids because their wage would not cover hiring someone to do so, to
Right.
keep care of the kids. I agree because it's you have to pay that hired help after tax.
Right.
So
And that's sort of.
may I just ask, don't you think that stimulus policies are in conflict with curbing inflation? Increasing the stimulus checks prevent people from coming back to work, as you mentioned. And
I don't know if they're in conflict because they're helping wage inflation to a certain extent. I'm just saying helping. It's not a good or bad connotation. I'm just saying because what I'm really trying to analyze as an investor is not really whether policies are good or bad, but what the effects will be on assets. And what this is doing, at least inflation, is that it's probably driving inflation a little bit higher. And we'll get into it because also the stimulus checks have increased the net worth of the bottom 60%. And that tends to be more inflationary. So if you give more money to someone who's making $1 million a year, he's not really going to spend that much more. He's just going to save a little bit more. So it's going to drive the stock market up. But if you give money to someone who's got zero at the end of the month, they're probably going to spend it.
yes,
They basically they can just cover their expensive. You give them a little bit more. Well, maybe they'll probably spend that. They have a higher likelihood of spending it. And so if that incremental dollar, if it's given to someone who's a low income earner, then it'll probably find itself back into the the system being spent and therefore creating inflation.
What is total PVT
Total PVT. I don't know what PVT is.
in the center?
Sorry, I don't know what you're pointing to.
I think I think that's total private.
Yes, total private. That's the overall of all the categories. So the job availability is pretty high. So that workers aren't too worried about their status. They believe that as you can see in that purple line, the job availability perceptions are pretty high. People think that they can get a job if they need one. However, the employment rate's still high, and that's been disconnected. And that's what makes me think that that's probably driven by the stimulus checks. And Barry's point as well on childcare probably is valid as well. So workers are not worried about their employment, and they're probably not worried. They're not as worried as they used to be about their net worth. This is the first recession we've had where the net worth and people's incomes have gone up during a recession. That never happens. As you can see here, actually the net worth of the bottom 60% actually went up during 2020. And that hasn't happened since, and it's never been at this high a level basically since pre-2008. And it's one of the highest since 1970. And the explanation here is on the left side. This is the household incomes and where it's coming from. And you can see that stimulus checks, and this is on a monthly basis historically, stimulus checks can account for a big chunk of where household income is coming from. That's a pretty big chunk. The wages and salary actually were negative. You can see that unemployment insurance provided a decent chunk as well. So basically government-sponsored money is what's driving a lot of the household income, or at least on the lower income bracket over the past year. So basically that was it for today. I said it was going to be pretty short. The conclusion is essentially the Fed right now, it's seen a high inflation print. It's not too worried about it. It's really focused on employment. What happens when the stimulus checks start dropping off around September, and if they're not renewed, then you might start seeing actually some people spending less, and you might get even a whiff of basically reduced inflation. So the biggest worry that you could have in the market right now is the Fed starting to taper. It doesn't seem that that's something imminent right now. It doesn't seem like the Fed would want to taper at this point. So if you guys have any questions, comments, happy to take them now.